If you've been staring at the markets this week, it feels a little bit like being at a party where the music just stopped.
And everyone is just sort of waiting to see who drops a glass first.
That is a disturbingly accurate description. I
Oh.
mean, we are all obsessing over this hot CPI print. Everyone's looking for a reason to sell. And, right in the middle of all that noise, you have SOFI.
Hmm.
And I have to be honest, if you're just casually glancing at the ticker this week, it looks rough.
It doesn't look like a winner at first glance, no.
It hit that high of, what was it, 1987? Which felt like a breakout, and then, boom, it settles right back down around 1961.
Yeah,
To the casual observer, that looks like a rejection. It looks like weakness.
absolutely.
But we aren't here for the casual glance. We're here to figure out if this is, I don't know, a trap or a real opportunity.
Exactly. We're here to look past that daily ticker tape.
Yeah.
And the data we've pulled for this deep dive suggests there is a very specific, contrarian, and honestly a pretty aggressive bullish story unfolding here.
Aggressive is a strong word.
It is, but when you look at the pillars we're about to discuss, aggressive is really the only way to describe the potential.
Okay, so lay out the mission. What are we looking at today?
We need to just ignore the daily noise for a second. We're going to look at three specific pillars that suggest a major outlook shift is hiding in plain sight.
Okay.
We're talking about the macro shifts, specifically the rate environment, then the digital traffic signals, which are flashing bright green, and finally the institutional moves that seem to contradict the fear in the broader market.
And when you layer these three things on top of each other, you think that drop to 1961 isn't a failure.
I think it starts to look less like a struggle and more like a coiled spring.
A coiled spring. Okay, I like that. Let's test that theory. Let's start with the macro environment. This is usually a part where people, their eyes glaze over, but for a fintech like SoFi, this is the air they breathe.
You really can't analyze a bank or a fintech in a vacuum. I mean, the macro is the playing field.
And the research brings up the catalyst we've been waiting on for what feels like an eternity: interest rate cuts.
Right.
But we've been burned on this before. We've been hearing cuts are coming since 2024. Why is this time any different?
Because the timeline has shifted from, let's say, hope to pricing. The market is now actually pricing in an expectation of 2.5 rate cuts in 2026.
2.5. Okay.
But more importantly, the potential for these to start is immediate. We're talking as early as March.
March, as in next month.
Next month.
Okay, but let me play devil's advocate here. 2.5 cuts is specific, but is it enough? The market seems terrified that inflation is sticky. If we don't get that March cut, does the whole thesis just fall apart?
Not necessarily, but it delays the gratification.
Yeah.
Here is why this matters specifically for SoFi. Think about their business model.
They're a lender.
A lending giant.
Yeah.
Student loans, personal loans, mortgages. When interest rates are high, two things happen. One, their cost of funding is higher. They have to pay depositors more. Two, and this is the big one, people just stop refinancing.
Of course, nobody refinances a 4% student loan into an 8% one. The volume just dries up.
Yeah, exactly. The gears get all gummed up. But when rates come down, even by 25 or 50 basis points, it greases the wheels.
Ah.
It lowers SoFi's cost of funding, which expands their margin, but at the same time, it triggers a refinancing wave. It's a volume and a margin expansion event.
So it's not just about cheaper money. It's about unlocking their core product demand.
Precisely. Lower rates are literally the fuel they need to ignite the next leg of growth. And the market is finally pricing that in for 2026.
Okay, so the weather's clearing up. That's the macro. But you can have great weather and still have a broken car.
That's a fair point.
Just because rates are down doesn't mean SoFi can execute.
Execution is everything.
And this next part was the aha moment in the research for me because it speaks directly to execution. We need to talk about web traffic.
This is one of the most reliable leading indicators we have in the digital age. For a company like this, anyway.
The data explicitly mentions record high web traffic. Now, pause there. In a vacuum, traffic can be a vanity metric. I visit websites all the time. I browse Ferraris. I'm not buying a Ferrari. How do we know this isn't just window shopping?
Because of the nature of the platform. You don't browse a banking app for entertainment.
It's not Instagram.
Right. You don't go to SoFi.com to read the news. For a digital-first company like SoFi, web traffic is the top of the funnel. But it's a very high-intent funnel.
High intent, okay.
And the research highlights a direct, massive correlation here historically. High web traffic correlates to massive member growth.
So if we see the traffic spike, we can reasonably assume the member ads number in the next earnings report is going to be big.
That's the logic.
Yeah.
We aren't just seeing server load. We are likely seeing accelerated user acquisition. And considering we are in the middle of Q1 right now, this is a real-time signal.
This is what I want to dig into. We usually have to wait for the quarterly earnings call to find out how a company did 3 months ago. You're saying this traffic data is giving us a preview? It's a crystal ball. I mean, this source suggests this momentum is setting us up for what could be a monster Q1 earnings report. And monster is their word, not mine, but the data supports it.
But if the traffic is at record highs and the member growth is presumably following, why is the stock trading at 19 bucks? The source notes that SOFI is trading at a substantial discount compared to its peers. Why the disconnect?
Well, that's the opportunity gap. The market is still trading on the fear of the macro, that inflation data we mentioned, while completely ignoring the fundamental performance of the company itself.
So the market is looking at the rain clouds, but the store is packed with customers.
That is the perfect analogy. And usually over time, that gap closes. Price eventually follows performance.
Okay, so we have the macro fuel waiting to ignite. We have the fundamental engine revving with web traffic. Now let's talk about the battleground, the technicals, because this is where the theory meets the actual money.
This is where the bulls and the bears actually fight it out on the chart. And for a long time, SOFI was a favorite target for short sellers. It was easy to bet against them when they weren't profitable, but the data shows a shift.
A significant retreat, yeah.
The numbers here are specific. Shorts recently returned about 459,000 shares. Now, we know how shorting works, but 459,000 shares. In the grand scheme of things, does that number actually move a needle?
It's not just the raw number, it's the trend. That return of shares brings the short interest down to 8.7% of the free float.
8.7%, is that considered low for a growth stock like this?
For a high beta volatile fintech stock, yes.
Yeah.
It signals a cooling off of that pessimism. It's not zero, obviously. There will always be skeptics.
Yeah.
But the easy money bet against SOFI is gone. The institutions that were betting on a collapse are taking their chips off the table.
They're blinking.
They are. They're seeing that floor we talked about and deciding it's just too risky to stay short.
Let's talk about that floor. Because if I'm an investor, I want to know where the safety net is. The research identifies a very specific floor or support level at 1955.
That 1955 level is critical. It's the S1 support.
And we closed right above it. What happens if we break it?
Well, if we break it significantly, then the technical picture gets muddy. But the fact that the stock dipped, hit that area, and buyers stepped in to hold it, that's a sign of institutional accumulation. It's the line in the sand.
Okay, so 1955 is the trampoline. We bounced. So if this narrative holds, if the rate cuts happen, if the web traffic converts, where are we going? What's the ceiling?
The next major technical target identified is 2114.
2114, that's the resistance.
That's the lid on the jar right now.
Yeah.
If the stock can break through that with volume, it usually signals a breakout. So right now, we're in this channel, holding the floor at 1955, eyeing the ceiling at 2114.
It's a tug of war, but it feels like the bears are letting go of the rope a little bit.
It absolutely shifts the advantage to the bulls. But there's one more layer here. We've got the internal data, the market mechanics, but we need to talk about the external vote of confidence.
The analysts.
Specifically, JMP Securities.
I saw this, and I have to admit, I did a double take. Analyst upgrades happen every day. Usually it's, we're moving the target from $17 to $18.
A little bump.
Yeah, or neutral to outperform.
No.
This was aggressive.
It was very aggressive.
They hiked the rating from $17 all the way up to $30. That is nearly double where they were. And more importantly, it's 50% higher than where the stock is right now.
It's a massive call. You don't see that very often.
Is it too massive? I mean, come on, $30. That implies a valuation reset that we haven't seen in years for this stock. Is JMP seeing something nobody else is, or are they just hyping?
I think they are looking at the compounding effect of everything we just discussed. If you get the rate cuts and the member growth continues at this record pace, the earnings power of SOFI changes fundamentally. A $30 target isn't based on today's earnings. It's based on the trajectory of 2026 and 2027.
So they're pricing in the monster future before it even happens.
Exactly. It's a vote of confidence that the long-term thesis is intact. It just cuts through all the short-term noise of the CPI data and says, look at where this company will be in 12 months.
It definitely changes the narrative. It's not just, can they survive? It's, how big can they get? And speaking of visibility, we have Anthony Noto, the CEO, hitting the conference circuit.
Which is no coincidence, of course.
The research mentions he's a featured speaker at upcoming major conferences. Is this just a PR tour, or does this actually impact the stock?
In the financial world, visibility is liquidity. When a CEO like Noto, who's very good at telling the story, is out there in front of institutional money managers, explaining the web traffic, explaining the loan growth, it puts the stock on the radar.
It reminds people, hey, we aren't just a student loan company anymore.
Exactly. It's a catalyst for brand visibility. And when you combine a CEO telling a compelling growth story with an analyst slapping a $30 price target on the stock, that creates FOMO.
Fear of missing out.
Yep, for a lot of investors.
So let's zoom out. We've been in the weeds with the support levels and the share counts. Let's synthesize this for the listener who is sitting there looking at their portfolio, seeing red from the market volatility and wondering what to do.
We have a clear disconnect.
A disconnect between the price and the value.
Between the immediate market fear, the reaction to the CPI, the general nervousness, and the underlying reality of SOFI's business.
So let's recap the layers. Layer 1, the macro.
Rate cuts are no longer an if, but a when. March is on the table for 2026. That is high-octane fuel for a lender.
Layer 2.
The fundamental data. Record web traffic. You cannot fake that. People are flocking to the platform, which predicts strong earnings ahead.
And layer 3.
The technicals and the experts. Short sellers are retreating. The stock is holding its support floor, and at least one analyst is calling for a run to $30.
When you stack all those up, that dip to 1961 doesn't look like a warning sign.
No. As the research concludes, the dip starts looking like a major opportunity.
It's funny because human nature is to run when things are volatile. When you see the stock down from 1987, your instinct is something is wrong.
That's a survival instinct. But successful investing is almost always about suppressing that instinct. The data suggests the future looks incredibly bright for those with the patience to wait for this whole thesis to play out.
It's about not getting shaken out by the noise.
It is. It's about watching those key levels, 1955 is your line in the sand, and trusting the leading indicators like web traffic over the lagging indicators like the daily stock price.
You know, this whole discussion about web traffic really stuck with me. We rely so much on quarterly earnings reports. We wait 3 months to find out how a company did. It feels so archaic.
It is a relic of a pre-digital age, isn't it?
It really is. And it makes me wonder, and I want to leave the listener with this thought, if we can see real-time web traffic, if we can see the digital footprint of a company day by day, are we moving toward a world where the quarterly earnings report is, obsolete?
That is a fascinating question. If the data is transparent in real time, the earnings surprise might just become a thing of the past.
Right. If you know the customers are walking in the door today, you shouldn't have to wait 3 months for an accountant to tell you they bought something.
Real-time data versus historical reporting. That could change the entire game of how we value stocks.
Something to mull over while you watch that 1955 level. That's it for this deep dive into SOFI's hidden signals. Thanks for listening.
See you next time.